Well, you gotta be flipping my flapjacks. Just in the past 3 weeks, the S&P 500's up around 15%. The Nasdaq's up 17.5% in the past 3 weeks. The S&P 500 and the Nasdaq basically have given you returns in the last 3 weeks of what they usually give in about, we can call it a year and a half to a 2-year span. And that's in 3 weeks. So at the top of this video, I want to talk about the markets, where they're headed from here, why this is going on, things like that, right? Then from there, we're going to talk about Palantir, Celsius, AMD. Holy smokers, this ain't no jokers. What a banger of a video this is going to be here today. What are my feelings about these stocks going into earnings? Do I think they're going to miss, beat, all that good stuff? We'll get into that subject, which I think shall be very, very interesting. These are 3 major investments of mine in the public account. AMD is now my second biggest position in the public account, and it hasn't even made a move yet. Can you imagine when AMD makes this move over the next few years, like how big of a position it's going to become? Palantir is a major position in the public account, $248,000, and Celsius is as well with a $153,000 position. So we will get into that. From there, I want to react to a 4-piece here today. We're going to react to this one from this gentleman. There are a few signs pointing toward a bullish comeback in the market. Looking forward to reacting to that one. Jefferies, here's why tech stocks are rebounding. Looking forward to getting to that one. A different gentleman from Jefferies says the best is over for U.S. stocks. Looking forward to getting to that one. And then we're going to hear from Mark Mobius in regards to his opinion on cash is king, which I think is a very interesting subject to kind of get into here, okay? Alrighty, guys, appreciate you joining me as always. Thanks so much for being here. By the way, thank you everybody that smashes that thumbs up button. You mean the world to me. Like, I appreciate you. You're awesome, okay? Plus, we're 90,000 plus subscribers deep now on the reaction channel here, which is absolutely incredible. Absolutely incredible. I love it. And additionally, if you're looking to apply to our private stock group, private wealth group, pin comment down there, access to all my best course curriculums, like Become a Master of the Stock Market course, Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery, Financial Statements Mastery, access to my private Discord chat, see the moves I'm making in my big dog portfolio. And when you join us in there, we get your Steel membership cards in the mail shipped over to your house. So that will be pinned comment down there. Click on that, fill out a form, see if we can get you access to that, get you up to a much higher level than where you've been at. Stop playing around in this market and start taking it serious, okay? Alrighty, guys. So, listen, the market. What did I tell you guys? What did I freaking tell you? I told you that when you are going through these dramatic markets, major craziness, right? VIX spikes to 50 plus. You have to be buying. There's not enough, you have to be buying. You can't see the VIX go 50 plus like it was a few weeks ago. You can't see the market in full on crash mode where it's just tanking day after day. You got a 1,000-point drop here and, oh my gosh, another 3% drop, 4%. You can't see a market like that and be scared. You have to be fearless. And you say, well, but there's so many scary headlines. Trump said this and tariffs this and China, blah, blah, blah. Listen, I've never seen it where the VIX has spiked 50 plus and it hasn't been scary. It's always, that's why it's so volatile. That's why the market is sinking so rapidly when you're in that sort of market. It's always been scary. It always will be scary when you're in that market. And that's what differentiates the men from the little teeny tiny baby boys, okay? You got to step in there and say, dude, I understand it's nothing but negativity out there. Everybody's talking so scared on X. Everybody's talking so scared on CNBC and Bloomberg and all the other financial networks. But you know what? I'm going to be brave and I'm going to go against the herd here and buy. And show me one time it wasn't the right decision. Doesn't exist. Every single time the market's in some sort of major correction or crash, it's always a buy. It's never not once ever worked out. That's the thing you got to understand. Show me one time the VIX went 50 plus and it wasn't a great buying opportunity. I'll wait. Doesn't exist. And yet people fall into the trap again and again and again of this time's different. Hey. I understand last time the stock market came back, but you know what? This time's different because of it. You know what they said last time? This time's different. You know what they said the time before? This time's different. It's just a different reason. That's all it is. And so you got to understand, you got to be out there buying. If you don't, you understand when the Nasdaq goes up 17% in 3 weeks, When the S&P 500 goes up 15% in 3 weeks, do you know what that means for like individual stocks? That means you're going to see some individual stocks that are going to move 20, 30, 40, 50%, folks. Not small numbers. Like, let me just pull up a few here, okay? And let's see how these stocks have done. Let's check out AMD. Let's pull up a good old, let's pull up, Tesla, let's pull up a Tesla. Let's see how some of these stocks have done. Who else should we pull up since that particular time? Let's pull up a Meta, right? Let's just see how some of these stocks have done since that time, right? Meta's up 18.8%, AMD's up 21%, Tesla's up 26%. This is in a 3-week span, right? It's not like it's small numbers. Let's see an elf on a shelf, like a smaller cap company, right? Let's even see, who else do we want to see here? Let's see somebody like a Netflix, right? Let's see how these stocks have done. Netflix is up 34% in the past 3 weeks. Elf on a shelf's up 31% in the past 3 weeks. Their earnings haven't even come out. We haven't even got any results out of them. And yet it's up 31%, right? That's what happens. And so if you're not buying, you got to understand, like, you make the most money buying when everybody is in panic mode. It's always been that way. That's where the biggest money's made. Same thing with 2022. No one wanted to own any tech stocks in the back half of 2022. There was like Netflix got down to under $200 a share. The stock's well over $1,000 a day. Meta got down to $88. It's over $600 today. Right? Like, I could go through the whole list of these stocks. They got to ridiculously low levels. Shopify got down to $25 in 2022, right? It's like $100 nowadays. And think about that for a moment. But you have to be brave. You have to step in there and you have to say, I understand everybody hates it. Everybody blah, blah, blah. You know what they were saying in 2022? This time's different because the Fed's raising rates. And it was true in regards to, the Fed's raising rates. They're in a hike cycle. It was true that, oh, wow, this is the scariest time for inflation data since the 1980s. That was true. But the whole notion around this time's different was wrong. It was just another great buying opportunity. And if you were buying those big tech stocks in 2022, you made out like a bandit. You've doubled, tripled, quadrupled, 5x'd your money. If you bought something like an Nvidia as it was crashing in 2022, you probably made 6, 7, 800%, right? And like 2022 wasn't that long ago. Like, we're only in 2025 right now. So you got to understand, man, you can't waste these opportunities because you don't get these opportunities very often. Like, how often do you get a major correction or a crash in the market? You get a major correction in the market maybe once every 2 years. You get a minor correction in the market probably every year, I would say, a minor correction. But you only get a major correction probably once every 2 years. How often do you get an actual crash in the market? Crashes, where we're talking the major indexes go down, 25 to 50%, that might happen every 5-10 years. And so whenever you get those major corrections or crashes, dude, just buy. I understand it's scary. I understand, it could get, who cares? Let it be what it's going to be. If you're getting great steal deals on stocks, take advantage. Take advantage, right? And so remember this, for all future crashes, whether we get another crash this year or correction this year, whether we get it next year, the year after, just remember what I just took you through. Always be buying and buy the heaviest when that's going on. Look under the mattress, when you're in a crash in the market or major correction, look under the mattress. Like, is there some money under here? You got to be buying, man. It's never not worked out. So, and I'll take the odds on something that's never not worked out. I always do. I've been doing it for 16 plus years. I'll do it for as long as I'm here. That's the bottom line in regards to that. Now, we got a huge week coming up this week. Palantir's reporting earnings. You have Berkshire Hathaway odd numbers obviously coming out. I think it's tomorrow. HIMS is reporting on Monday as well after the bell. So that should be interesting to hear what HIMS has to say. That's a very hot stock relatively. Well, it was a very hot stock. Then it went ice cold, right? Now it's coming back to life. So I'm interested to see what numbers they report there. Celsius reporting before the bell on Tuesday. You have AMD report after the bell on Tuesday. Winning Resorts as well, right? You have Oobity Booba and Disney reporting before the bell on Wednesday. That Disney's going to be interesting to hear what they have to say about travel. Because from what I'm hearing, a lot of the international folks are not coming to America right now. They're on a boycott. The Canadians are on a boycott. A lot of the Europeans are on a boycott right now. They're not coming to America. They're kind of anti-America right now. So they're saying, we're going to spend our summer travel money somewhere else. We're not going to America. And so that's going to be interesting just to see like what that means for a company like Disney. We already got a little bit of a glimpse of it with Airbnb last night. Airbnb kind of sounded a little bearish in regards to travel here in the short term. Vegas numbers haven't been great as well. So you kind of got a boycott from the Canadians and the Europeans right now about like not going to America, which I understand, like, you know, with everything that's been said out there, I get it. And so that's just something that's going on short term. Like at the end of the day, like long term things will be fine, but it is something that's going on short term, right? Dutch Bros is reporting after the bell on Wednesday as well. Shopify, which is another stock I own. Wynn and Shopify are two stocks I own. I just don't own them in the public account. But those are two stocks I'll definitely be keeping a close eye on as well. Then we had Trade Desk TTD after the bell on Thursday, which should be really interesting as well. Now, how am I feeling? How am I feeling about AMD, Palantir, and Celsius? Well, here's the deal. AMD I'm feeling very bullish on, right? Who knows what happens with the stock price after these earnings. But the moral of the story is, here's what I'm expecting from AMD. I'm expecting double beat. Beat on earnings per share. No, triple beat. I'm expecting beat on revenue, beat on EPS, beat on margins. Okay. Guidance. Very strong. There's no... I expect AMD to be ahead of their guidance and ahead of where analysts are at. And I have no reason to say, no, it's not good. No reason. 0% reason. And the reason being is, look at all the big tech companies. We already got all the big dogs reported, right? Other than NVIDIA. What are all the big dogs that are spending all like crazy? Microsoft, Meta, Google. They all are keeping intact their CapEx budgets, or they upped the CapEx budgets. And keep in mind, AMD is just about to get to the fun stuff in regards to MI350 launching, and like the big time AI opportunity just starts really this summer, which is actually, you know, part of the quarter we're in right now because we're in the April, May, June quarter. And so we actually could see a decent amount of MI350 number in the guidance, right? Then we get to MI400 next year, and then we're at a whole different stratosphere as far as growth rates go. So like I have no reason to think like, oh, I'm scared about AMD. I'm nothing but excited about AMD. And like I said, I'm expecting, if anything, they're going to up their guidance numbers, and they're going to sound extremely optimistic. And that's going to be huge for the semiconductor industry, but it's going to be even bigger for AMD because they haven't even had their party yet. Remember that. NVIDIA's already had its party, right? That's why the stock has gone up like 800%, 900% since those 2022 lows. AMD hasn't even had its party yet. The party's about to start in regards to AMD. That's the important thing you got to remember here. So I'm expecting a very good conference call. Lisa Su does not just pump and hype to hype. She's never been like that. She's not that type of CEO. She's just going to tell you how it is. And I think it's going to be very freaking good and very optimistic. And so we'll see. But I'm feeling very, very good about that one. If I had to say, is the stock price going to go up or down? My guess is up. But honestly, as a long-term shareholder, I'd rather have it be down short-term because I'd rather buy some more AMD shares for cheap. But keep in mind, even if the stock goes 110, 120, it's still cheap. Like I think AMD has a real potential to be a $300 to $500 stock a few years from now. So, you know, AMD at 98 is a buy, AMD at 88 is a buy, AMD at 118 is a buy, 108 it's a buy, 128 it's a buy. Like, it doesn't matter. Now, in regards to Palantir, it's very simple in regards to Palantir. If they have another acceleration of the rate of growth, very important, not just grow, you got to see an acceleration of revenue growth percentage. So let's say last quarter they grew, what was it, 36 or 39%? I'm having trouble remembering what the last quarter number was. You see a 36 or 39%. Now they really need to push that growth rate into the 40s. If they do that, Palantir's fine. Party on, baby. If they don't, and the revenue growth starts to decelerate, you're going to likely see a big sell-off in the stock. Not just after earnings, but you'll see that for likely the next several months. Because people will say, oh, like we already peaked in regards to our percentage revenue growth. The party's like going to get a little lame from here, right? Because then people will start to assume like, okay, we're going to go down to 35% growth, and then 30% growth, and 25% growth, 20% growth, right? And so like the company's still growing, which is great, but it's not as exciting. But if you see them push up to that 40% number, or they guide for a 40% plus number, party on. You know, Palantir's stock price will have trouble when the revenue growth percentage decelerates. Okay, make sure you understand that. For the newbie investors, I hope you understand what it means between an acceleration of growth versus a deceleration of growth. Once again, it's like if I was growing my company at 35% clip and then I accelerate it to 40%, bullish. If I go from 35% to 30%, bearish for a high valuation stock like a Palantir. So make sure you understand that. All the high level investors, which is probably 90% of you guys watch this video, you get that, right? But for the 10% that get confused and they're like, wait, but they'll still be growing. It's not about that. Like, this is higher level stuff. Like, once you've been in this game a long time, you've gone through my course curriculums in the private group, like you'll get it, right? You start to understand like, oh, this is bigger than just like I'm growing my company so my stock price goes up. It's way more complicated than that, okay? So that's in regards to Palantir here. No, Celsius. Okay. Celsius is going to be interesting. It could be a little messy. By the way, look, we're already at 36% on Celsius. So already off to a great start in regards to that position, right? And that's still a very early days position here. Here's the deal in regards to Celsius. So they got the deal with Alani going through, right? So numbers short term could just be a little bit messy is the best way I could put it. But I don't think anybody really cares that much about the short-term numbers. The conference call, I think, is very much more important about, are we going to get the Celsius brand back to nice growth as this year goes on? What's the Alani growth rates going to look like? What are we looking at for EPS once the deal's completed for next year? And so I think the words are a lot more important than the numbers in regards to Celsius. If the Celsius conference call is a banger, Celsius stock price will boom as we go along this spring and into the summer. If the numbers are, if the conference call is bad, the stock's going to falter. The stock will go right back down to, probably $30 a share, $28 a share, or something like that, in that range, if the conference call is bad. So trust me, the words matter more than the numbers. When the numbers first come out, they'll move the stock a little bit, but I'm telling you, the conference call, so much more important, because of the big Alani deal and everything going on there. So, and also people are going to want to know about Pepsi. Pepsi's been a huge drag on the business because of that distribution deal. If we're in a situation where management team can confirm that's completely 100% behind the company now, if they are able to put that line in the sand on this conference call and say, it's over, like that is done, that's a thing of the past, and now it's just growth, boom, you'll see Celsius go right back $40, $50 a share, right? And then party on. So the words matter more than actually the numbers in regards to that whole situation, right? As far as Wynn and Shopify go, Vegas has been a little bit weak in regards to numbers, so that's a little bit troubling. Macau still looked very respectable. Shopify always puts up great numbers, so I never have a question about that. What happens with the stock price? Who knows? But one thing I'll say about it is the only way Shopify could really have that stock boom and go up 10, 20% on these earnings is we need to blow out the numbers, because the only way you can really get your stock price to go up right now in this market, as far as for the tech companies, you have to smash, man. You can't just come in and beat your numbers. Amazon's a perfect example of that, right? Amazon came in and beat their numbers, but it wasn't a big enough beat, so the stock was flat today, right? Look at Apple. Apple came in and actually beat all their numbers, but stock went down. Shopify, the only way that stock's going up big after these earnings, they got to come in and smash, man. They got to post an EPS number that's huge that people say, oh my gosh, what? They got to post a net margin number that makes everybody flip their flapjacks. All right, let's react to some videos.
There's been, what I've picked up is kind of, you start to get the weekend think pieces. Are people going, just be careful. I think Bill Gross had something to this effect too, where he said, look past Meta and Microsoft, and there's, less to love about the market. And I know he's often pessimistic, but give some reassurance to those who are concerned that we came back a little bit too quickly here.
Yeah, Kelly and Brian, thanks for having me back. Appreciate it. Happy Friday, everyone. So listen, the longest win streak, obviously, since 2004, in all likelihood here. Well, I was thinking some things to talk about. One thing that's interesting, and you guys might like this. We had a 19% near bear market. We all know that. Over the top negative sentiment. No, the economy is not perfect. It's slowing down, but it's not nearly as bad as we thought this time 3 or 4 weeks ago. But as of right now, we have corrected more than 50% of that near bear market. When I went back in history, when you have these near bear markets like we just did, once you correct 50%, only once have we rolled back over to make new lows. And as everybody knows, that was in 2022. The other like 10 times before that, we didn't make new lows. Listen, this isn't perfect. I get it. We get in the weeds of it. But listen, there's a lot more positives out there. One more quick one here. Market breadth has been so strong, even on the 19%, near bear market. If you look at advanced decline lines, they really held in there. Right now, this second, the advanced decline line on the S&P 500 sitting at an all-time high. Usually, the way I learned it a long time ago, breadth leads price.
Ooh, okay, so there's a lot here. Okay, first off, let me, before we get into this sell in May and go away situation, because that's something that always comes up around May. Listen, we got the perfect situation going on right now. And let me explain this, okay? Here's a perfect situation. You've got economic data that is clearly weakening, right? No debating that. There's no question about that. Look at the GDP numbers, look at the JOLTS numbers, everything like that. Okay. So the Fed now has a full green light to cut interest rates for the next, I would say, at least 6 to 12 months, right? No question. And also inflation numbers have not come in nearly hot enough to make you say, oh gosh, inflation's so scary. You got to worry more about the economy if you're the Fed right now at this stage of the game, because inflation is pretty dang dead. And so the Fed's got a green light to cut rates for the next 6 to 12 months, right? But meanwhile, you have earnings that are actually holding up very well for companies. It's not like we have some tanking of earnings and Meta just reported disaster and Apple reports a disaster and Amazon reports a disaster and Google reports a disaster and the numbers are just awful and it's like, oh my gosh, like all these companies' earnings are tanking. That's actually what you had in 2022. It wasn't just everybody was scared about the Fed raising rates. It was also, if you look at the growth rates of all the big tech companies, they went down to like nothing. And they started we looked at net incomes and earnings per share that started going down like 40, 50% on a year-over-year basis. It was a disaster, right? Some even more than that. And so you don't have that. Like we've got all the big tech companies now to report, all the Mag 7s, and earnings look great, other than obviously Tesla. That's a whole other situation. But everybody else looks great. Apple looks better than ever. Google looks better than ever. Meta looks better than ever. Amazon looks better than ever, right? So what do you got to go off of? Shoot, not much. So that's very important that everybody understands that, man. We got the perfect situation. We got a Fed that's about to go through a cut cycle, and we got stock market earnings that actually look very respectable, at least in terms of the biggest stocks that matter the most in the market, which are those Mag 7 stocks, right? So now, don't sell in May, right? Because there's an old saying in the stock market, sell in May and go away, right? So this is interesting. May through October returns in the S&P 500. 2020 was up 12%, 2021 up 10%, 2022 was obviously a really down year, down 6%, 2023 was up only 0.6%, and then 2024 was up 13.3%. So basically we have 3 years of the past 5 were banger years, May through October, right? So if you sold in May and got out of the market, bad decision. We have 1 year that was bad. So 1 year would have made sense in 2022 when the Fed was going through a hike cycle, right? And you had big tech earnings tanking off a cliff. And then 2023, you should have probably just stayed in because still we ended up positive. So what should you do? Stay in. To try to play the timing game, foolish.
I get the headlines, I get the worries, but this is a healthy market. And I'll tell you what, the lows of the year are probably in, and the bulls might have a little more fun.
All right. You said a lot, and we're glad that you're here. And we don't know where we're going, Brian. To be perfectly blunt,
and keep in mind, in regards to this market, I don't know how anybody's not talking about this, right? Look at how fast the market's bouncing back, right? We looked at it earlier. S&P 500 is up like nearly 15%, as Nasdaq's up 17+%. But think about this for a moment. We haven't even had a bunch of big trade deals announced yet. What happens when you hear this big trade deal and this big trade deal and all this stuff get announced, right? And what happens when you start hearing headlines like China and the US are close to a big trade deal being finalized? We haven't even got those headlines yet. What happens if and when that happens? Where do you think the market's at that particular time? These are things to factor in that not enough people talk about.
And I hope you're right. A lot of our viewers and listeners hope you are right. Go back to that data you just rolled out. So when we have this kind of violent correction, like we fall and then we come back, 100% of the time, the markets are higher a year from now. correct?
Yeah, that's right. When you have
That's a
because
lot
again,
of percent, 100.
It's pretty high. Now, listen, the statisticians would say it's a small sample size, and I would agree. If there were more examples, Brian, we would use it. But that's what we've seen, these violent corrections. And at night, I know, Mike Santoli pointed this out, 19% for whatever reason in 1976, 78, in 1990, 2011, 2018, we had 19% near bear markets. Intraday, you clipped it. Everyone gets all bared up, and then you hit the low. And we're there again, Brian. And that's just, some positives, I guess, things to think about here.
The weirdest thing about this, and you referenced there's one time where we didn't get the stat that you referenced, that was 3 years ago, 2022. It is amazing that we forget the market fell 25% top to bottom intraday in 2022, lost 1/4 of its value. It's up big since then. Mm-hmm. But yet it got almost no attention, probably because it was slow bleed from January to October, just kind of like just a death by 1,000 cuts. This one, very different. How do we compare 2022, which got almost no attention for some reason, to now?
Well, if you were there, you remember it. Maybe we need to have you and Howard.
I was hosting specials Sunday night.
We were doing a lot of those together. I think you need Howard Lutnick on more. You've had the market rally a lot since you and Howard talked about things. But listen, Brian, what happened in 2022? All right. The whole globe sold off. What are we seeing now? Like U.S. and India are the only two markets really down. The rest of the globe has been really strong this year. So that right there is one major difference. Also, bonds did terribly in 2022. So diversified portfolio, forget it. It was a rough year. Bonds have done okay this year. We all know gold has done well. So some of those diversifiers this year are doing well. That's a really good I work with financial advisors every day, right? That's a great reminder to financial advisors and their clients why we preach to stay diversified, why you don't chase a shiny object, why you diversify, why you rebalance, why you do these kind of boring things, because then you have a year like this, and it wasn't fun this time a couple weeks ago, but being diversified, it honest to goodness hasn't been as bad as it seems as if you're in only the Mag 7, which we have not been.
I know, Brian, this isn't what you kind of, spend your days and nights poring over, but we talked last hour to Bill Smead, who's out at the Berkshire Hathaway meetings. That'll be fun to listen into tomorrow. And we all know about the Buffett indicator, right? The measure of, I think it's total market cap to GDP. That continues to just climb and climb and climb and climb and climb. So I take your point about staying in the market and building long-term wealth in everything, and that's what we do. But do you take a metric like that and ever worry about it?
Let me answer that, okay? Here's what we're looking at. We're looking at the biggest, most powerful companies hitting profitability levels that we've never seen. We're looking at these companies getting even more profitable. I mean, you have companies like Amazon, not Amazon, but, Amazon actually will end up eventually getting there, but like Meta and some of these other companies that they're starting to be able to have AI write a lot of the code for these companies, right? Which is bringing down their cost of doing business in a substantial way, right? Which ultimately is going to end up producing not just gross margins, but net margins like you've never seen before. And these companies have already gotten to that place, right? A lot of these companies are now having net margins in the 30+% range. You go back 15, 20 years ago even, no one thought it was possible to have net margins the 30+%. And if you did do that, there was like some freak one-off thing or something like that. There's no way you could sustain 30. Now you got many of these tech companies that are doing 30% plus net margins almost every single year, unless there's some sort of one-off weird expense or something like that. And now we're going to be talking about some of these net margins for some of these companies are going to start to go to the 40% level. 40% net margins, meaning for every $10 that comes in, top line, at least $4 reaches down that bottom line. That's after all your expenses, your taxes are taken out, everything. Ridiculous. And that's the sort of levels we're getting to here, folks. So, I think that's something important to factor in.
Or at some point, is it just a data point that's going to fall by the wayside?
Yeah, I think Mr. Buffett himself has kind of said that he's not so sure if it's quite the same indicator. Maybe we'll find out this weekend. But I will say this, Kelly, along those lines. Tech has been pricey. We came into this year, tech has been pricey. Parts of the U.S. market are clearly pricey, but there are a lot of other parts that aren't. Small caps, mid caps, financials, industrials, they're not as stretched. So those are some value. Let's call it value. Value and low volatility, two areas we've liked. They've done pretty well this year. So if someone doesn't want to buy the pricey things, I couldn't blame them. There's a lot of other parts, though, that are cheaper, and that's that's, I think, important for investors to always remember those things. I'm sure Bill probably pointed that out too. That's something to think about.
No, he did. And he pointed out this irony, right? Like,
yeah.
The company Berkshire has all of this cash. Investors are getting a little itchy because they go, okay, in the long, T-bills are fine for now. But you've got to buy. And Warren said, I remain committed to equities. But what companies or what publicly traded or otherwise can they buy to move the needle at this point? And if you don't jump in when you get these little market opportunities, is he waiting for a much bigger pullback, thinking that things are, still dramatically overvalued here? I don't know.
Yeah, it seems like he is. Let's not forget, he's made some really big bets in Japan. He's made some big bets around the globe. So he's looking around at some of these other parts that are a little bit cheaper. I know one more quick one here. Everyone talks about sell in May, go away. Just know this. The last 10 years, May's been higher, 9 of them. And these next 6 months, which are usually fairly weak, have been higher 8 out of 10 times. So don't just blindly sell in May, go away. In fact, we think we'll probably get a pretty good rally, guys, in May and into the next 6 months, honestly.
Should we?
Hey, there's a trash truck driving around my neighborhood right now, picking up the trash barrels. How much do you think somebody makes driving one of those trash trucks? I'm gonna guess $75,000 a year. That's my guess. But my guess is, depending upon market, it could probably range between 65 and 95,000. That's my guess. But my guess in Vegas, maybe somebody drives a trash truck, maybe like 75,000. That's my guess. Alrighty, next one up here. Here's why tech stocks are rebounding.
Announcement after a big rebound driven largely by tech this week. Jefferies chief market strategist David Zervos is here with more on the road ahead and to help us understand this
Look at
past
my guy.
week. David, thanks for joining us.
Looking like he used to be in a rock band back in the day.
You.
Good to see you, Carl.
What do you think accounts for this rebound?
So I think a lot of it had to do with the confusion in the second week of April. That second week of April, the correlation patterns, Carl, they just went wacky. We saw one of the largest moves higher in long-term interest rates since the early 1980s. We saw dollar weakness and we saw equity weakness. A correlation pattern that I think many said was associated only with emerging markets. People were talking about the return of the 70s and stagflation and losses of credibility. And I think it was a flow-driven story. I think adversaries in the trade war that have large piles of U.S. securities used some of those to try to dislodge the post-trade battle announcements in April 2nd. And we sort of recovered largely on the back of statements by the Secretary of the Treasury that they could stop that through buybacks and other mechanisms. So I think we found some ground and dealt with that issue, and that issue is now off the table. And I think the market is looking forward at all the things that are much more positive about a leveling of the trade imbalances, a leveling of the fiscal imbalances, a deregulation story that's still in the background, and a lot of positives that really were the topics of our discussions for the first month or two of this year.
Do you believe the Japanese finance minister when he says, and I want to get the quote right, we obviously need to put all the cards on the table in negotiations. It could be among such cards, referring to their treasury stockpile.
I did see that. I thought it was a very strong statement. And I think it's true. It's true that in this negotiation, everything is in play. But the U.S. still holds the cards here, Carl. They really do. This is not something that is going to dislodge the trade negotiations. If there is nefarious foreign selling of duration in the U.S. fixed income markets, the Treasury and the Fed, either one, on their own or together, can stop that and turn that purely into a currency trade through either an issuance change or a QE change. And that is important because the currency change is actually going to help the U.S. rebalance because they're going to be weakening the dollar, which brings us back to a more competitive place. It's the duration when they sell it that dislodges our capital markets that gets in the way of these trade negotiations.
There's also this idea that there's really nowhere else to go. Right, David, that's always been the case for the dollar, for the Treasury market, and I think increasingly for U.S. growth. A few weeks ago, we were sitting here on the desk talking about the Sell America trade because of the tariffs. Now, with the Mag 7 earnings coming in pretty much strong, as Dan Ives was just saying, AI theme very intact, with the de-escalation in trade and with the better economic numbers even coming out of some of those trade announcements, Is it Buy America again? Is that what this is all about?
I mean, I don't think Buy America ever stopped, Sarah. I think there are people that will move to the euro. The euro is the natural place. It's the biggest place you can go to an alternative to the dollar. And it has been an incredible run. In the last 2 months, the euro is up 10% relative to the dollar, 5% in the last month, even with the stock market and bond market largely unchanged. This has been a major, major currency trade, Sarah. Something I know you watch very carefully. In fact, last night we saw the Taiwan dollar move 4% stronger.
That's a trade. If even with all the excitement about Germany spending this year, the U.S. is the only one of the big economies in the IMF that's supposed to grow almost 2%. I mean, even with all German spending, I think it's barely going to grow this year.
You're not going to get me to get excited about buying European stocks. That's not happening here or at any time soon. But I do think the euro is going higher. And I think the dollar is going weaker. And I think the story is really a 1985-style Plaza Accord story, where in trade negotiations, we are going to rebalance the playing field. And part of that is ending what this administration sees as currency manipulation. The dollar is still very strong. It's within the last 20 years, the euro's traded at 160. Dollar yen's traded at 75. The pound is traded over 2 to the dollar. This is an extraordinarily strong dollar, and it makes us less competitive. It is the standard competitive devaluation story that we've seen over and over again in many, many circumstances. And I think I call it, in the U.S.'s case, a competitive revaluation, because we're not devaluing. It's still a strong dollar world, still a reserve currency dollar world. I think part of what the Commerce Secretary, the Treasury Secretary, the Trade Representative are all going to put on the table is a program by which countries have to think about not just changing what they buy from the U.S., not just getting their trade imbalances set through purchases or through tariff changes, but also through currency policy. And maybe what we saw in Taiwan last night was the beginning of a move toward a more plaza-like dollar rebalancing trade, which should be really helpful in bringing our trade deficits down and rebalancing what this administration sees as an unfair trading playing field.
Right. Yeah, so it's interesting. I don't know if you guys have been seeing what's been going on with the earnings, but there's been a really fascinating thing going on where essentially many of our big, companies that do business internationally have been definitely going into some headwinds in regards to currency. Almost every single big company I've seen, their revenue growth would have been stronger if you kind of factor in a constant currency basis. But because they've actually been going into these big headwinds in regards to currency, it's actually been hurting their revenue growth on a year-over-year basis. For instance, Meta grew revenue 16%. But from what I remember, if you factor in, if it was a constant currency basis, Meta's revenue would have been up 19%. That's a pretty substantial difference, a 3 percentage point, right? Because, when you start talking about 19%, people are like, dang, man, nearly growing 20% clip. Like, it looks a lot better than 16%, right? So, there's something to kind of factor in there. All right, the best is over for U.S. stocks. Okay, let's hear some bearish take.
The most top-read stories that we had last week, basically saying that you think the best is over for U.S. stocks.
No, Fred, yeah, I've been stating since the start of the year that my base case, until proven wrong, is that U.S. equities reached an all-time peak of MSCI All Country World Index on the Christmas Eve last year. So I think it's an all-time peak in U.S. dollar terms, just like Japan made an all-time...
It's just a ridiculous statement. It's so silly. Such a ridiculous statement, man. Like, sometimes I'm like, do these guys even think? Do they even think about like the most base level stuff? What makes a stock market really valuable? What makes companies really valuable? What makes companies really valuable is that they dominate all over the globe. They do the most business. They have the best products. And until that is changed, you're not going to see you see a short-term shift, but you're not going to see a long-term shift there. If all the strongest, best companies start to come out of Europe, we got a different world. If the next Apple, Meta, Google, Nvidia, AMD, if they all come out of Europe, okay, now we can start talking about, oh boy, US peaked and like European markets are not going to take over, right? If all the strongest companies in the world all come out of China, we could talk about that, right? Or they come out of Japan. We could talk about, okay, yeah, U.S. stocks have peaked and, other countries are taking over. But until that happens, you can't make that prediction. Until you get the next ChatGPT comes out of Europe or China or wherever, okay, then we can talk. Then we can have that debate. But until then, you can't have that talk. You can't have that debate, right? And the thing with China is China creates a lot of competitive companies. But the issue with China, no one wants to invest in China. They don't trust it. They don't trust big dog, Xi. They don't trust are the shareholders even going to get the profits? They don't trust their financial markets. Pull up the Shanghai index. It's like, you would look at the Shanghai index. I think the Shanghai index hasn't gone anywhere in 15 or 20 years. Something ridiculous. You could pull that up, look at the chart over the past 17, 20 years, whatever, and you're going to see oh man, this thing's hardly done anything for all this time. Despite, the Chinese economy growing massively and so many good Chinese companies coming out of there, what do you got to show for it? A whole lot of nothing. And so to make that statement, it's just so silly. It's just ridiculous, man. It's just ridiculous. I just wish people would just think base level sometimes. They get so caught up in all this higher level stuff that sometimes you just got to break it down and it's who's got the best companies in the world? Who makes the most money? Okay. Who's going to replace that? Yeah, crap. We don't see that. Who's innovating the fastest? Until the beat, you can't say that. It's just crazy.
Peak as percentage of world stock market capitalization at the end of 1989. But obviously, I'm assuming part of that is a weakening dollar.
Right, but so is this on tariffs and some of the turmoil that we've seen, or this is just more of a structural effect of the way the indices work?
No, this is a structural thing because, frankly, the U.S. reached, I think, 60...
And you know what's crazy is you look at all the biggest next industries, artificial intelligence, robotics, sustainable energy. You could go through the whole list of the next, massive industries. Who is leading? Who are the leading companies in that? It's all U.S. companies. It's all U.S. companies. All U.S. companies are leading in all of those spaces. AI, robotics, sustainable energy. Go through the whole list. U.S. companies are leading there. What do you got to go off of? You know what I mean? Just what do you got to go off of? It's crazy. Who's got all the leading LLM companies? Go through the whole list.
% of world market capitalization. This is extreme. Even if the U.S. economy is doing well, 50% would be a high weighting. And we had all this talk of American exceptionalism in the fourth quarter of last year, which was a sign of a massive top. We had S&P trading at an all-time peak of price to sales. The tariff noise is just an additional negative. So if Donald Trump really does go ahead with the tariffs, then clearly you should sell all these stocks today now. Now, there's still a chance that he backs off, but, the simple point is that tariffs are very bad news for everybody.
Yeah, and I guess...
We're all the strongest fintech companies as that continues to take off. Digital banking, all that. Where are all those companies located? Oh, they're all U.S. companies also. Where's all the biggest, most dominant banks? Oh, U.S.
Just adds a layer of complexity, right, to try and understand where it goes. I mean, is U.S. exceptionalism now over? Full stop?
No, I don't. I never believed in U.S. exceptionalism in a financial sense. There's one area the U.S. isn't completely exceptional in financial matters. That is the ability to print the reserve currency of the world. That is the true source of American exceptionalism in financial issues. But the irony is that the Donald Trump agenda actually threatens that huge privilege of the U.S., which is indeed to print the reserve currency of the world.
Yeah. But Chris, why are markets not really seeing what you're telling us? So there has been a correction, but actually, if you look, they've been pretty much flat since January.
No, we've had a big relief rally, and it's partly encouraged by growing hopes that Donald Trump's going to do a U-turn on the tariffs. Right. Which he's already done. He's already done significant U-turns. So clearly, if he announces today no tariffs, the markets can rally further. But it won't just be the U.S. rallying. China will rally and other markets will rally. temporarily.
Right, but do you think even if tariffs are taken off or they're tempered somewhat, that actually there's permanent damage done to, what people see as the havens of the U.S.?
Yeah, because actually there's real catalyst to buy, Mark. This year there's a much better catalyst to buy Europe than there is the U.S. because euro is much cheaper. And we've had a very distinct positive catalyst, which is the German fiscal revolution, the revision of the debt brake, and Germany is going to kick in with fiscal expansion. So there's a catalyst in Europe you don't have in the U.S. The question in the U.S. is, do you avoid this negative catalyst of higher tariffs?
In all due respect, the gentleman is just missing the biggest point. Where are all the biggest, most dominant companies in the world located? For all the big next future industries, where are all the biggest, most dominant companies? Like, they're all U.S., man. They're all U.S. And then the number 2 is clear. It's China. And then after that, what are we going to debate here? If Germany has stronger companies coming out than France or Australia or New Zealand or Japan or South Korea, like, what are we talking about here, man? Come on. Canada, Mexico, like, in all due respect, don't be ridiculous. This gentleman's being ridiculous.
We did a chart, Chris, where basically...
Because he's missing the most basic thing.
To encompass some of the earnings, because we're in full earning season, so they're coming left, right, and center. And we basically put them in 3 categories. The ones that, the U.S. companies that could be okay under the tariffs, the ones that really struggle, and the ones that haven't really said anything, so they can't quantify it. So we put, for example, UPS, Pfizer, and P&G in there.
And we haven't even talked about a lot of these type of companies that are dominant all over the globe, right? Like, gosh, you know what I mean? Like, it's not just we dominate in tech and new industries and like all this big stuff. Then we could dominate in all this other random stuff. Like food, like McDonald's dominates all over the world, and Taco Bell and Chipotle, and like, you know what I mean? It's just like, gosh, like, who's the 2 biggest drink companies by far and away in the world? Coca-Cola and Pepsi. You know, you can see their products in every major country, and they sell phenomenal, and all their different brands. And geez, man, who's selling all the cigs all over the world? Like, come on. Like, you just go through it. Come on.
Do you look at sector to choose, or is it just regional?
Well, no, there's another issue. Let's say we suddenly hear there's going to be no tariffs. That'll be very bullish. But we still have then the issue of the massive amount of capex being spent on big techs on the AI story. So personally, my view is that they're overspending on this AI story. Yeah. I think DeepSeek was a huge moment. And the message of DeepSeek is that so-called large language models are going to become commodities. So even if you take out the tariff story, I think there's an issue for big tech. And the market will probably start to refocus on that when we get this earnings season.
Okay, Chris, do you sell off some U.S. stocks at the moment to buy, for example, European stock, Japanese stock, and UK stocks?
Yeah, but I would be adding to China, Japan, Europe, and India. That's where global investors should be diversifying away from the U.S.
I mean, it's easier maybe for India to find new trade routes than Europe if they have to choose between China and the U.S.
No, India won't want to play both sides. There's no reason for India to make an enemy of either. But right now, Donald Trump needs to do some tariff deals outside of China, so that creates an opportunity for countries like Japan and India to negotiate a better deal with the U.S. than if there wasn't this pressure on the Trump administration.
As head of global equities, I'm sure you look at the Treasury market as well, because are they still...
I have a theory. Some will call it a conspiracy theory, but I have a theory that I actually think the United States, I believe we want to help build India over the next 2 decades. There's actually no doubt in my mind that it's actually an agenda of the United States, regardless of who is in president right now. I don't care if it's Trump or Kamala or Biden. I don't care who is president right now. I think there's an agenda to build India over the next 10, 20 years. There's no debate in my head. Kind of like if you look at really 2000, we could go 1995, right, to really the 2015. I believe there was an agenda from the United States of America, regardless of who was president, whether it was Clinton, Bush, Obama, to build up China and created a massive market, right? And we got tons of benefits from that over the last 20, 30 years, if not 40 years. And obviously China got built into a big economy, and a ton of our companies make a lot of money out of China, right? But now there's like that, China's grown so big that, it really started to be viewed around 2015 of like, hey, these guys are, becoming a force, and like, we don't want to let them become the big dog. Like, we got to remain the big dog in the world. And so there's been this kind of move out of China over the last decade, and it's going to continue to ultimately, China's going to still be a beast economy, an animal. But it's very clear to me, like, we're going to keep China at bay now at this point in time, right, for this next several decades. And I believe we want to build up India next. And so I believe there's going to be a very concerted effort. It's already started, by the way. It already started, honestly, it started about 5-7 years ago now at this point in time. But I believe over this next several decades, it's going to be a huge effort to build up India into a massive economy, right? And with India, it's not as scary politically, right? China, there's always a lot of worries because of the way their political leadership works, right? Of what could happen there, right? India, there's not as much of a worry there. And I believe there's going to be a real effort to build up India strong, right? And also make a great ally there that hopefully could be even a much stronger ally than China's been. And so that's my belief. And so I'm very bullish on India over the next several decades. But with that being said, would I rather go buy the India stock market versus no. Like, you could look at the Chinese stock market. Like, no. Like, you still got to own the biggest, most dominant companies, and those companies are American corporations.
Are treasuries still a haven in the U.S.? And if not, how are they behaving?
No, I've been bearish on treasuries since March 2020 when the Fed printed all that money because of the pandemic. So my view is that treasury bonds have entered a long-term bear market, all G7 government bonds, and I've preferred since then local currency emerging market government bonds. I'd rather own long-term U.S. corporate bonds than the treasury bonds, because U.S. corporates have far superior balance sheets to the U.S. federal government.
And how
Interesting. Okay. Next up here, veteran investor Mark Mobius, cash is king.
Boom like no other, but suffice to say, it's been damaged like no other. How are you assessing Trump's first 100 days?
Well, I think the first thing we must remember that he has made revolutionary changes that affect not only the U.S., but the world. It's an amazing feat that he's accomplished in the sense that he's upset the apple cart, so to speak. So we're now in a new era, a new way of thinking about politics, about economics, and so forth. So the first thing that comes to mind is that we've got to get used to a whole new order, a new way of thinking, and also we've got to get used to uncertainty. We think the uncertainty will continue for the next 3, 4, 5, 6 months, and we've got to get used to it. Now, when you have a situation like this, of course, it opens up opportunities. We've seen the market come down. Some stocks are looking very attractive, and most particularly, countries like India will be benefiting from what's happened with China, and the other countries that will benefit. So some of these emerging market countries will do quite well in this environment, but we have to wait until all of this evens out and we see a settling down of this uncertainty.
Mark, you talk about a new way of thinking. Suffice to say that...
In all due respect, I laid this out back on Inauguration Day. The whole Trump presidency is going to be crazy. It's going to be volatile. And as I've stated many times, like, you're going to have moments where it looks like everything's lost and we're just going to keep crashing. You're going to have other moments where it's like, oh my gosh, let's go buy the biggest mansion in the world. Like, that's going to be the market the next 3.5 years. It's going to be up, down, all around. It's going to be very volatile, and there's going to be some phenomenal moments when you're just counting the money like crazy, and there's going to be some moments where you're like, gosh, like, is this market ever going to go up?
The market thinking has kind of seen a rewiring. Talk to us about the psyche of the investor right now. Is it about fundamentals? Is it about, keeping up with the headlines? How have things changed in the way markets think, in the way investors think?
Well, of course, as soon as Trump made the announcements regarding tariffs, the first thing he did, of course, was create this great uncertainty, and the market came down. We're looking at 20%, depending on what market you're looking at. Now, usually when you have a drop like that, people start thinking, maybe we should start picking up a little bit, or at least not selling anymore. And I think we've reached this point now The next step, of course, is to assess what comes next and where the opportunities are. Obviously, some companies are going to benefit from this tariff situation globally and some will not. So what we're doing is looking at the whole picture globally and saying, okay, let's make an assessment of what we can expect going forward. And what that means, of course, is a total new way of looking at trade, looking at politics, and looking at economics.
What gives you the optimism this will pan out the way you're expecting?
Well, I think we have to be patient. We have to wait for the next 2, 3, 4 months to see how this all pans out.
100% disagree. 100% disagree. You wait and wait and wait in these markets and you get left behind. It's as simple as that. Like you could said 3 weeks ago, I'm not buying the market. You've already missed out on 17% gain in the Nasdaq. You already missed out on 20, 30, and 40% moves in stocks, right? That quick. Now let's say you wait another few months and the market just kind of keeps rallying, right? You get some sell-offs here, but at the end of the day, it just kind of drifts higher and higher and higher. And then all of a sudden, we're several months from now, and all the trade deals have been announced, and all of a sudden, China trade deals coming. Like, you could be up 30% on the Nasdaq from the bottom you hit a few weeks ago. Then countless stocks are up 40, 50, 60, 70, 80%. And so, to play the whole waiting game till the coast is clear, you can't do that, man. That's not where the big money's made. When the coast is clear, that's where the little money's made. When the coast is like, dude, we don't know where that coast is at, that's when the big money's made.
One of the things you must remember with Trump, he is in a bargaining situation. He is trying this, trying that, threatening this, pulling back. So you're going to see more and more of this negotiation and bargaining taking place.
Yep.
And within the next, I would say, 4 to 6 months, this will all pan out, and we'll see a settling of what the agreements are going to be with various countries.
Do you still maintain that all markets are in play right now, except perhaps China, which is the crux, which is the focus of the trade war with the U.S.?
Well, all markets are in play. There's no question about it, because everybody's uncertain. But you can see strength in some of these markets. For example, India is doing quite well. Some of these other markets are doing okay. But at the end of the day, the uncertainty will remain. And of course, China will be the big question mark. If China does not come to the table, and if no agreement is reached with China, then I expect China not to do very well.
How have you been navigating the market? Are you dipping your toes in markets you haven't before? What are some of the changes you made in your portfolio? And what in particular are you looking out for that will shape how you think, about where you place your money in the next few months?
At this stage, cash is king. So 95% of my money in the funds are in cash.
Oh my God.
We're playing a little bit with S&P 500 index funds just to keep tune of the market, because the S&P is a leader globally. But we're also looking at some of the emerging market stocks, but in a very, very careful way. I think right now we've got to keep cash and be ready to move when the time is right.
But keeping 90% of your funds in cash, it's really, really high. That's possibly the highest I've heard so far. Why do that? Aren't there enough opportunities out there for you to be deploying your capital?
Well, when you're getting 4 or 5% with no risk in dollars, you're doing quite well. Of course,
that's 4 or 5% over the course of a year. The Nasdaq's up over 17% in the past 3 weeks.
Hold that for the whole time. It's not going to be more than 3 to 4 months when we begin to do more, depending on where the market is. If the market comes down further, of course, we will be putting more money in.
It's not even worth me commenting on, okay? I'm just going to get too crazy. It's going to get out of control. I appreciate everybody joining me as always. Thank you so much for being here. Thank you for always joining me for these videos. A beast of one here today. Oh my gosh, 59 minutes. I appreciate y'all. If you're looking to apply, join a private stock group, private wealth group, take your investing game up to a much higher level than where you're at. That will be pinned comment down there. Much love and have a great day.